Mike Larson here with a crucial update on something very interesting that happened in Washington yesterday. We had Federal Reserve Chairman Ben Bernanke go before Congress to present his semi-annual testimony on the state of the economy. And rather than spew a bunch of happy talk or do a little more of this sort of hemming and hawing about the economy, for once Mr. Bernanke was crystal clear about how things are. They stink. He admitted that the labor market is the worst since the Great Depression. He talked about long-term unemployment being a consistent problem and how it'll take years to get back to where we were pre-recession. He also mentioned that the federal deficit is very out of control in the long term and that that's a problem. And on top of that, he discussed the outlook for housing and admitted that housing still remains a huge lead anchor around the economy. Frankly, we're not surprised, and you shouldn't be either. We've talked about this. We've talked here at Weiss about the likelihood of a double-dip recession, so you're prepared for this. But it's still striking to see the Federal Reserve Chairman, who's supposed to inspire confidence in the economy, come out and speak frankly to people. That's a refreshing change, and I hope it sticks. Another interesting thing that happened in Washington is we got the latest quarterly report from a group called SIGTARP. Now, I know Washington loves their acronyms, but suffice it to say this is a group that has oversight for how the TARP money is spent and how effective many of the government programs that spend that TARP money are. Very startling numbers and startling commentary out of SIGTARP about the HAMP program, the mortgage modification program the Obama administration rolled out with a lot of hope and hype. Essentially, what the group found was that more old modifications, people who had previously got modifications of their loans, more of those people are dropping out of the program than you have new modifications coming in. In other words, there's no net impact on foreclosures because many old modifications are failing even as new ones are being made. Again, this just goes back to what I've been saying about housing, that distressed inventory is going to continue to be a problem, especially in a case like this where the labor market, in Mr. Bernanke's own words, remains the worst that we've seen since the 1930s. So folks, please take account of this double-dip recession scenario when it comes to investing, whether you're talking about your stocks, your currency investments, your bond investments, all of it could be impacted by a double dip. And that's frankly exactly what I see and what Mr. Bernanke is talking about now. Thank you.